Are you noticing something? Stock market valuations have been expanding like a balloon for some years now, and the bubble of overvaluation may be about to pop. Now, while this is not financial advice, I want you to look at some of Warren Buffett's recent moves with Berkshire Hathaway for some very important hints at what we can expect. Warren Buffett's cash position has been on a consistent rise since 2022 and now stands at a staggering $277 billion. That's because the holding company Berkshire Hathaway has been dumped some of its biggest stocks in the last few months, including selling half of its Apple stock holding in August, which crashed the company's valuation by over 5% the next day on August 4th. Combine that with a stock market that looks way overvalued. Is there something big that Warren Buffett is preparing for? Well, take a look at what he says in this year's Berkshire Hathaway meeting when asked about his drop of Apple stock.
You mentioned there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions. And you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now.
Understand that no investor is going to spell it out for you, especially not one as powerful as Warren Buffett, whose words can make entire markets. But try to read between the lines for what he said. It's possible he might make moves to acquire more Apple stock by the end of this year, which perhaps tells you what he's anticipating. You hold cash when you want liquidity to buy up stocks when they crash down to their real value, and Berkshire's cash position tells you that Warren Buffett believes the stock market is overvalued to an unjustifiable degree. What's eventually going to happen? Well, all it's going to take is one trigger to set off that realization in the market, leading to a domino effect taking over. What could that trigger be? It could be anything like a major company going bankrupt, unexpectedly high unemployment rates, a major war overseas, or even a single statement by someone in an extremely important position. Here's what he said at this year's Berkshire meeting, saying that you don't need to swing at every pitch, which is a phrase that holds a lot of hidden meaning.
This question's from Johan Halen, who writes, you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it. But we only swing at pitches we like.
It's a rule of the market that what goes up must also come down, and right now indices like the S&P 500 and the Wilshire 5000 have been on constant rise after the pandemic that isn't justified by the fundamentals of the business they represent. And you can gauge that not just from the price to earnings ratio, but also the Buffett indicator that has predicted a market crash over half the time since it has been used. It takes a very holistic view of the market in relation to the economy by dividing the total valuation of the entire stock market by the total size of the nation's GDP, and that makes sense because a country's business cannot realistically be larger than a country's total gross domestic product or output. A higher percentage signals an overvaluation, and the Buffett indicator has been above 120% for more than 6 years at this point. In fact, it stands at 195% in 2024, with the total market cap of companies at over $56 trillion, when the total US GDP is just above $28 trillion. It's only so long that this balloon can keep inflating before it finally pops. And when it finally does, there's going to be a lot of undervalued and correctly valued stocks ready to be scooped by anyone with the cash to do so. Looking at how Berkshire Hathaway's cash position has also been increased since 2016, it really does seem like Warren Buffett is again playing the long game and waiting for the right moment to pounce. Obviously, since he's not going to say it right now, I dug up an old clip of him from 2001 where he talks about his aversion to having idle cash sitting around, despite the fact that it's necessary if there's no good opportunity.
We obviously are looking every day for ways to deploy cash, and we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se. In the mid-'70s, we were scraping around for every dime we could find to buy things. We don't like lots of leverage, and we never will. We'll never borrow lots of money at Berkshire. It's just not our style. But you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it.
And there's two kinds of disciplines that it requires. First, it's the year's worth of patience at having a large cash position while waiting for the market to adjust to a correct value. And then secondly, there's the necessity of resisting temptation to put your money somewhere else while you wait. Warren Buffett was actually given such an opportunity back in 2008 when he also had a large cash position insurance company, AIG, and the Lehman Brothers Investment Bank, who were the catalyst for the 2008 crash. Approached Warren Buffett for a bailout when they were just about to go bust, Warren decided against it despite the fact that the deal offered potentially attractive incentives. But in hindsight, you realize just how well it turned out for Warren to resist the offer. In that sense, holding cash and waiting may sound like a passive strategy, but it takes a kind of discipline that not a lot of people have. That's why Warren advises most people to put their money to work in investment vehicles after putting aside an emergency fund.
So how much cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent diversified businesses, you don't really need any cash.
Warren Buffett's investing philosophy has one thing that's unique, which most people will never develop, and that is the sheer amount of patience that he has to keep waiting even for years or decades for the right opportunity. Way too many people are impulsive, given to euphoria, and go along with what other people are doing. And doing that today means putting your money in an overvalued market and then likely pulling it back out of fear once it goes down and then giving in to FOMO when it rises back up. It's a never-ending game that you can only escape one way, which is to think on a long-term scale and have patience. Let me know in the comments how you process this philosophy, because it's amazing how well it holds up today as much as it did in Warren Buffett's earlier investing days.